This is InvestTalk. Independent thinking, shared success.
Hi, Justin, Luke. This is Bill from Toledo, Ohio. Longtime listener to the show. Love the content. The stock I'm calling about is ticker symbol MRK, which is Merck and Company. Just wondering if now's a good time to get into it. It's been beaten up pretty good, but everything I see, it looks to be pretty strong. Margins look good. Free cash flow looks good. Sales growth and EPS growth looks good. So just trying to figure out why it's taking it on the chin so much. I look forward to hearing your answer on the show. Thank you.
Merck is a global pharmaceutical company. They are a pharmaceutical giant. They have a pretty diversified portfolio that specializes in oncology, vaccines, diabetes, et cetera, et cetera, et cetera. And as with any pharmaceutical company, a lot of the value of it is derived from its drugs that it is, or not just its drugs that it is producing and selling now, but what it has in the pipeline. Now, yes, it is still a giant of the pharmaceutical world. It's still a nearly $200 billion company. Its revenue is still growing, albeit more slowly than the 6.5% you saw on average since 2019. And its margins are still pretty solid, right? In 2024, net margin 26.8%, projected to expand to 34.5% this year. Now, with that being said, right, it has had quite a rough 52 weeks, down 38.68% over the past year, down 19.42% year to date, and it's pushed it to a point where it's trading at 8.5 times forward-looking earnings, which is near the 5-year low of 8. And so the question is, why is this the case? Well, Keytruda, one of their drugs, continues to have some pretty strong demand. Q1 sales grew at 4%. But Gardasil had a notable drop, right? We've seen it for 2 consecutive quarters. Very weak Chinese demand. Q1 sales were only $1.3 billion on the drug, down 40%, prompting a shipment pause to China. And then on top of that, they do have some pipeline progress, some drugs that are in phase 3 trials, but not enough to have them boost their guidance going forward. They've had some pretty poor guidance for 2 consecutive quarters now. And again, Gardasil is a big drug for them. And geographically speaking, China's a big market, making up about 10% of their revenue, even after the big drop-off. And so it goes back to what I originally said about pharmaceutical companies. Yes, the drugs you're selling now matter. And in this case, one of their biggest sellers, Gardasil, not doing well. But then the other part is what is in the pipeline. And yes, they're in late-stage trials, but nothing really exciting there, such that I think that there's a huge catalyst in the near term. Now, we did at one point own Merck in some of our portfolios. We sold at the beginning of this year because we saw the path forward with the administration. We saw the HHS secretary's history of attacking Gardasil and didn't think that the market would really like that position for the company. And so for now, we still have to maintain a no on Merck. That is Merck and Company, ticker MRK. Thanks for the call. All right, let's keep things moving and get to a question from our InvestTalk YouTube comment section question bank. This one from our friend Captain Saw. It says, longtime listener from Nambia. I'm doing my MSc in financial management and doing a project on First Quantum Minerals. Listed on the TXS, which is the Canadian Stock Exchange, ticker FM, wondering what your thoughts are on this company. Let's take a look at First Quantum Minerals. It is, like I said, a company that is listed in Ontario in Canada. It engages in the production, exploration, and development of copper, nickel, gold, zinc, and other additives, and operates through a bunch of various business segments. Looks like most of its revenue comes from Asia and Australia, about 79% of its revenue. 10% of its revenue is coming from Europe. Now, that's the geographic segment. Let's look at a breakdown of what most of their metals is from. Well, this is still, again, on their business segments. Let me see if I can find something on where it comes from. About 80% of the revenue, it looks like, comes from copper itself. So they got mines in Zambia, in Mauritania, in Panama, all over the place. Now, as of Q1 2025, when they filed their annual report, looks like they did show that they were growing in terms of their operations for which they were mining. Now, I would expect that this company, well, they're doing pretty well over the past year, up 27.5% over the past year. Why? Well, they're positioned pretty well within the copper market, and in spite of where copper has been, it still has an essential demand for industrial and green energy transition uses. They also have pretty wide diversity. But, anytime you have some of these mining companies, you have to be pretty cognizant of some of the political risks, especially when you're operating in countries that are non-developed countries. In the DRC, in Zambia, in Panama. And you also have to understand the commodity price sensitivity as well. Look at this revenue growth all over the place, or rather the revenue all over the place. Positive, negative, actually fell. And in spite of that, it's up 17.86% year to date. And so, this is a very small company, $848 million market cap. And it's trading at 51.8 times forward-looking earnings. Incredibly expensive. Can be incredibly volatile. When I go for miners, because of the regulatory risk, I like to spread it out. I like bigger names. So for now, I would pass on FM First Quantum Minerals. Alrighty, it looks like we have a live call from Sammy in San Francisco, who has a question about Uber and is listening on AM 1220.
Hi, Luke. Thanks for taking my call. I wanted to get your view on Uber. I have been watching the stock for a little bit, and recently I heard that they're getting into the AI business, LLMs and things like that, which is kind of above and beyond what they are known for. So there may be an upside potential there, but I just wanted to get your view on Uber to see if this would be a good time to pick it up and kind of keep it for long term.
Okay, let's take a look at Uber Technologies, and we might not have time to fully answer this before the break, but Uber is, and it started as, a ride-sharing platform. It was a brilliant business model in that essentially its goal was get everybody to use this service and be at a loss. Once everybody has this as an integral part of their lives, then we start charging more money. And that's why you see in terms of net profit, they first started making money in 2023. Now their margins are pretty solid, sitting around 12%. Now year to date, they're up 41.31%. Over the past 52 weeks, up 21.41%. And compare that to the rest of the S&P 500, They're drastically outperforming here, as well as outperforming tech more broadly. Now, they moved into freight. They moved into mobile delivery of food when they saw that market because they had the infrastructure and the ability to do that. Gross bookings up 14% year over year. Revenue up 14% year over year. They had 3 billion trips. Their monthly active customers are up 14% as well. And so when we come back, we'll dive into, is AI something that can be the next catalyst for the next leg upward? Now, for the break, we were diving into Uber. We were talking about it finally turning profit in 2023, its margins expanding, its revenue growing, and its usage growing as well as an expanding operation into food delivery and freight. And so the recent news a couple of days ago was that they're also going to expand their AI solutions business. And that was really the core of Sammy's call, right? And when you hear, okay, most companies utilizing AI, oftentimes I think that it is just a way to boost stock price in the short term. It's like a couple of days ago, or a couple of years ago rather, when anything that was blockchain would go through the roof. And so in a similar way, that's my first thought here, but this is different, right? This is actually expanding a business that Uber already has, where it helps provide data to labs and to companies and data service businesses from their users, right? They're monetizing their user data. And so when you couple that with the announcement also that they're going to launch a new foundry to train internally AI models as well, I kind of like that. And the reason why is Uber has a massive amount of data, and the way you get the way you improve these models is by processing more and more data. And so with that in mind, Uber has transitioned and is in the middle of transitioning into a more mature revenue generating and business expanding company. It's trading at 26 times forward-looking earnings, which is cheaper than it has been on average for a while, right? But you do have to understand it's had a pretty big run up over the past year. Upside probably a little limited because of that. I like it. I like where it's moving. I would wait for a little bit of a pullback before I tossed any more money in there. That is Uber Technologies, ticker UBER. All right, let's keep things moving and get to another fresh question from a listener in Denmark.
Hello, InvestTalk. I have a question about an ETF, VDE, Vanguard Energy ETF. Wouldn't you recommend a themed ETF like this? I think the energy sector at the moment seems quite attractive with all the turmoil in the Middle East. But I know that many professionals, they advise against themed ETFs and would rather suggest normal index funds like the S&P 500 or the MSCI World Index. So I was wondering what your thoughts were in that direction. Thank you very much. This is Yannick from Denmark. Bye.
Alrighty, VDE is the Vanguard Energy ETF. It is a 9 basis point expense ratio fund that is passively managed. And so it's all the energy companies within the MSCI USA IMI index. Because of that, it's about 86.84% large caps, 8.46% mid, 3.95% small caps, and a little bit of micro caps as well. Now, I wouldn't call this a themed ETF. That's not what this is. It's a sector ETF. And I don't think you should put all of your money in the Vanguard Energy ETF. I don't think you should put all your money in any sector ETF. But the ways that you can utilize sector ETFs is to make active bets, right? If the core of your investment is something like a market cap weighted ETF, right? Like the S&P 500 or the Russell 3000 or some MSCI global index, you can tilt towards these sectors and use these funds to essentially go after whatever your theme is, whatever your thesis is. And so if you're trying to tilt towards energy a little bit, again, don't put all your money in the energy ETF. This is a good way to do it. Why? Because it's broadly diversified, but also it's cheap. You moderate your risk while still taking active bets relative to the overall market. And so if that's what you're trying to accomplish, I think that's perfectly reasonable to use something like the Vanguard Energy ETF, ticker VDE. Alrighty, this year has certainly been a year of rising tensions, not just between the US and China in terms of trade, but the US and pretty much everybody else. Now, since 2019, what we've seen is over 80 companies, Chinese companies, have been delisted from US exchanges because of a decade now of rising political and regulatory tensions. Because of this, Chinese companies now make up less than 2% of the New York Stock Exchange, and 30% of their 2% is just Alibaba. Now, not only are companies delisting, you're also seeing Chinese IPOs decline. They're now small, on average, just about $7 million, and often lack investor confidence at all whatsoever. And so this is more of a self-delisting issue, right? There are a lot of US lawmakers, a lot of state lawmakers who are lobbying, pushing the SEC to eliminate Chinese listings pretty much entirely because of many concerns, because of security concerns, because of concerns over accounting measures, because of forced labor for some of these companies. And so you're seeing a lot of firms, again, just self-delist here. Didi, PetroChina, pretty large firms pull it out of the United States markets due to pressure from Beijing to avoid U.S. scrutiny. I don't know what that says about their internal controls and their ability to undergo an audit, but it speaks for itself, right? In 2022, there's an audit agreement which was supposed to improve oversight But what ended up happening? You had a lot of Chinese companies list in the United States under this structure called VIE, Variable Interest Entity, and that lacked a lot of shareholder protections. And so that kind of undercut what the goal was in that 2022 audit agreement. Now, despite them not listing in the United States as much, you're still having banks like JP Morgan help Chinese firms by listing via Hong Kong entities, which is further undercutting some of these US policy goals. And the reason why a lot of people are concerned, again, potential scams, market manipulation, shell companies that are misusing listings. Understandably, if you're an investor, if you're a lawmaker, if you're supposed to be enforcing some of these rules, well, you're going to be a little bit concerned. Interestingly enough, as of now, for the first time in decades, no Chinese state-owned enterprise is listed in the US. And that was after China Mobile was forcibly delisted just a couple years ago. Understandably, as we can all see, the political climate under this administration and really bipartisan sentiment against Chinese financial ties continues and will continue to contract the amount of listings and the exposure investors can get on US exchanges of Chinese companies. The trend, regardless of the alleviation of trade tensions, seems to be holding, and the concerns are very real. Alrighty, let's keep things moving and play another caller question now.
Hello, Andrew Beal from Maine calling. Thank you for your show. Very helpful. I have a question for you about Unum Disability Insurance, long-term life insurance company, UNUM. I have held a full position in this company since 2021 and have done very well on it. But I'm feeling like it's a bit priced to perfection on the three driving factors to its valuation. One being general employment, second being interest rates, and the third being claims. I've already trimmed quite a bit, but I'm thinking I should trim even more. Good company, I feel like, but just feeling like it's perhaps a bit priced to perfection. Would love your opinion. Thank you.
Yeah, so Unum Group, ticker UNM, it's an insurer. They specialize in workplace disability, life, and supplemental benefit insurance. Geographically, all of its revenue, for the most part, comes to the United States, about 92% of its revenue, about 8% internationally. Now, it's a fairly large company, about $13 billion in market cap. It's up 57.46% over the past 52 weeks, up 9.64% year to date. A lot of this is because some pretty solid net earned income growth. Their net income looking pretty solid, as well as does the growth in earnings per share. Now, it's trading at a pretty reasonable valuation, though, right? 8.5 times forward-looking earnings, near the upper end of its 5-year range, albeit, and slightly above its book value, which is something you don't typically see of insurers. Now, recently, revenue did miss expectations. Return on equity, though, greater than 20% on its core operations. It's a complicated question, right? You can say, okay, it's priced to perfection here, but the growth for this company is still here in spite of missing on recent earnings. And they've done a pretty good job of managing claim variability through the better part of 3 quarters. And so for us, right, we're expecting earnings in just about a month now. A lot of analysts are expecting a little bit of an earnings recovery coming into this most recent quarter. And so Unum Group, which has performed very well because of this growth, because of this expansion in earnings per share, albeit minus the last quarter, because it does so with very little debt on its balance sheet, because of all of these things, we actually own Unum in one of our strategies. And so we did start to trim it a little bit, but we think that the headwinds to earnings were a little bit temporary. So for us, we're not making any more decisions until we see what comes about in Q2 results expected in late July. If you're up a lot, I think it's perfectly reasonable to trim and invest elsewhere. But for us, we're still holding on to this name. That is Unum Group, ticker UNM. Alrighty. You are listening to InvestTalk now with more than 61 million downloads. And Justin and I really want to thank you all for that. And to celebrate that, why don't we keep things moving with another question?
Hi, this is Dan from Walnut Creek, and thanks for taking my call. I have a couple of stocks that I have in a portfolio where I've purchased some stocks that have done well in the past and that were down on their luck. I've done pretty well with this portfolio. But I've got a couple. I have Deckers Outdoor Corp, DECK, and CROX Incorporated, CROX. And I was wondering what your thoughts are on these two stocks. I plan on holding them for a few years. If you could give me some input on those two, I'd appreciate it. Thank you. Bye.
Okay, let's take a look at Deckers Outdoor first. It is the parent company of Haka and UGG. About 64% of the revenue comes to the United States. About 36% of the revenue is international. Had a rough year, down 50.54% year to date, down 38.52% over the past 52 weeks. Revenue growth, fantastic from 2020, but slowing down into this year. And again, they've had poor guidance as well. Their margins, still fantastic for this type of company. Between 14 to 19% net margin over the past 4 years. Supposed to settle down at about 16.9% this year. It's currently trading well below its 5-year average. The average is about 22.3, currently trading about 16.3 times forward-looking earnings. Q4 revenue beat. Q1 revenue beat as well. They have pretty strong brand momentum, but because of this tariff pressure, right, because of the costs of manufacturing these things, of importing these things, well, they have been struggling pretty much all of this year. Now let's take a look at CROX, which is ticker CROX. And CROX is Crocs. They're those funny little shoes that have the holes in them and the little thing that goes over your foot. And sometimes you put it behind your heel and you're in sport mode. They also own the Hey Dude brand segment as well. Now, this company is also down, but down far less, down 11.1% over the past couple months. That's year to date, down 37% over the past 52 weeks. And in a similar fashion, revenue is projected to not grow that much this year as well. But when you're looking at these two companies, right, I think that revenue growth was substantially stronger with DEC. Their margins were also a little bit better, 58% gross margin, set around 24% operating margin. And both of these kind of face the same risks. The same macro risks, the same tariff-associated risks. And so, given this, if you have to choose between one of them, I think you'd probably want to go with CROX. Lower valuation, right? It's only trading at 7.7 times forward-looking earnings, substantially below on a percentage basis its 5-year average. It has solid free cash flow. About $719 million in free cash flow for a business of its size, right? It's about a $5 billion business versus the similar amount, exact same amount of cash flow nearly for Deckers for a business that's 3 times the size. But the key here is if you are willing to stomach trade policy turbulence that can turn on a dime. And so for me right now, I think given the exposure to tariffs, I'd probably stay away from both of these names, but if I had to choose one, I would go with CROX. That's Decker versus CROX. We're going to CROX.
Quick question on ticker symbol LYV. That's Live Nation. Seems to be doing pretty well. You know, they're in the events and concert industry. Balance sheet looks okay. Just wanted to get your thoughts on it. Let me know when you can. Appreciate all you do. Thanks.
Live Nation, ticker LYV, is a $36 billion ticketing company, right? An entertainment company. They engage in producing, marketing, and selling live concerts. I believe they also own some venues as well. Pretty globally diversified. 62% of their revenue comes from the US, 20 from Europe, and 18 from elsewhere. Most of their revenue coming from ticketing and the concerts themselves. Now, in terms of earnings, right, they did have solid revenue growth, slightly below estimates. Their earnings per share in their most recent quarter, Q1, also missed consensus as well. But in spite of that, concert activity was up 12% year over year. And because of this, they're starting to expand their footprint, investing $1 billion in various cities to have some sort of ownership in venues themselves, not necessarily huge concert venues, but smaller venues as well, putting on more and more shows. And they also started to expand into Latin America and Japan. So obviously the revenue that's coming in, they're reinvesting into the business. It's providing them good opportunities. Now, it's done particularly well, but there are some things you should be cognizant of here, right? There is a hostile DOJ going after what, the Biden administration started, some of these junk fees. What are these lawsuit outcomes going to be? There's definitely some valuation pressures here as well, given that it's up 62% over the past year. It's trading at 60 times forward-looking earnings. And so for a company that's trading 60 times forward-looking earnings, whose main revenue source is something that really gets hit in a recessionary environment, people don't tend to go and pay a bunch of money for concerts, tickets that are already crazy expensive when they have less money to spend. I don't know. Good company. It's got its tentacles everywhere within the concert business, but too expensive given some of the risks. That's Live Nation Entertainment, ticker LYV. See if we can squeeze one more question in now.
Hi there, Justin and Luke. I have a question, gentlemen. I finally have some cash on hand. I'm looking at a couple stocks, and I was wondering to get your opinion, please, on if one would be better than the other. The first that I'm looking at is COP, ConocoPhillips, I believe that is. I'm wondering if oil is making a comeback. I don't know if they also do any natural gas or any other work of that nature, but I've been seeing their price and they've been moving up slowly. The other one I'm looking at is HMY, Harmony Gold. I believe they also do, some copper too. I don't know if I'm too late for the gold rush, but hopefully not. I feel this one is well positioned. What are your thoughts on these two? Look forward to hearing it on the show. Have a great day.
So this is interesting. So this is the opposite side of the spectrum here, because on one hand, you have oil, which has been doing very poorly, and gold, which has been doing really well. And so the question is, are the trends going to continue, or do you end up buying the top of gold? And can you possibly buy the bottom of oil? Given how cheap it's getting, if you have a longer term time horizon, I would probably be more willing to invest within the oil space if you don't have any oil exposure at all. Again, because of the risks of not understanding how quickly things can move. That's why I don't think it's ever a good idea to completely be out of a sector. And so if you have zero oil exposure, congrats, you're getting in at some pretty bottom prices here. On the opposite side, gold tends to move positively as things are devolving, and then quickly the opposite way all at once and unwinding. And so the risk of being at a top here by buying something like Harmony certainly exists. If you have no gold exposure, I think it's a good time to be invested in gold because of the uncertainty we have globally. If you are in it more for the long term and can stomach the depressed demand, well, the next couple months may be a good time to pick up some oil stocks. That's COP or HMY. Thanks for the question. We did it. We made it. It's the end of the show. I'm Luke Guerrero, and this completes another InvestTalk program. Justin and I thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Guys, we really appreciate it. Just tell one person to subscribe to InvestTalk on either iTunes, Google Play, or Spotify. And while you're over there, please be sure to leave us a review on iTunes. If today's show made you think about your financial picture, your investments, your taxes, your retirement, whether it's all really working together, let's chat. At KPP, we offer no-cost portfolio reviews to help bring clarity and confidence. It's kind of like when you go to the doctor, not because you're feeling sick, but because it's something you should do every year to prevent the bad issues. If you're interested, just go over to investtalk.com and click the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.